But selling something shortly after buying it doesn't alone make you a trader. So let's move on to the second point of distinction, the analysis. To understand how the analysis of a company and its stock price varies between traders and investors, we first need to explain the difference between a stock's price and its intrinsic value. Theoretically, the price of a stock only reflects the number of buyers and sellers trading that stock at that given point in time. And past this stock price, there's some intrinsic value, a true worth of that stock that only an omniscient being would know. Over time, the price of the stock should track closely to this intrinsic value as buys and sells factor in company information known by the investors. But human factors like fear or greed might lead a stock's price to deviate from its actual worth from time to time. Within the world of investing, people take two approaches to this information. Passive investors ignore short-term fluctuations in stock prices and look only to benefit from the rising intrinsic value, knowing that even if they do buy an overpriced stock, they should benefit in the long term as the aggregate market grows. Active investors instead try to estimate a stock's intrinsic value so that they can buy the stock for less than its worth, allowing them to benefit not only from the rising intrinsic value, but also from the return of the price to its intrinsic level. While these two approaches vary from one another, they both generally depend on the intrinsic value of a stock increasing. Traders, on the other hand, only care about the stock's price. There is no attempt to estimate the intrinsic value of their stocks. And indeed, many traders buy and sell stocks without even knowing what the company does, looking only to take advantage of the short-term swings or trends in its stock price. For this reason, it's common for traders to focus their analysis on technical indicators. These are measures and gauges that only take into account historical pricing information.